is 3.95 as a par rate. If the borrower wants a lower interest rate, they can get a lower rate. They can effectively buy down to right here if they wanted to. But they'd have to pay 100 minus 97.79 is how much? About 220 basis points, or 2.2% to get that rate. Okay, so most people don't do that because that's multiplied by the loan amount. That'd be $2,200 on a $100,000 loan, and you'd end up in a high cost situation because the points are too high. But if the borrower is still stubborn and wanted to still get a lower rate, he could probably come down right over here. And the way that I would quote this is, these things change all day, like just how the market changes. So it's not like this is already, see, it's already closed, the market's closed, but you could quote this at 99, because in 5 minutes that could be 99. So because these things fluctuate all the time. Tomorrow that could be par. If we see a huge sell-off in the market, that could be par. And so the way that it works is with interest rates, they move with the 10-year and the 30, well, the 10-year bond. And so when the yields go up, interest rates go up. When the yields go down, mortgage rates go down. So what influences that? A lot of it's the Federal Reserve, the market in general. Today we saw that the yields went down because Janet Yellen said that she's not going to raise rates. As a result, that will affect it affects interest rates. So the 30-year interest rates are more influenced by the 30-year bond, and so not to get too much into that because it's going to take us off, but it's good to explain to your customers so you have knowledge on when you're talking about rates and when's the best time to lock. Today we saw that the market rallied, and actually bonds went up for a little bit, and then they kind of came back. They're all over the place today, but so the key thing to understand is that there's a difference between bond and yield. So when the bonds go up, the yields go down. It has an inverse relationship. So don't get confused. If you see bond prices going up, that means the yields are coming down. So conversely, if the bond prices are going down, that means the yields are going up. Okay. So when the yields go up, that means the economy is getting stronger. Okay. So people have to, when the economy is getting stronger, that means interest rates are going to rise. Okay. So that dampens gold, and that affects the dollar too. So, the key thing here is if you're trying to time the market with trying to lock in an interest rate, you can watch the 10-year treasuries and see what they're doing. If the yields are going up, that means rates are going to go up. If the yields are going down, that means the interest rates are going to go down. So you can watch that, but that's the yield, not the actual price of the bond. So there's two different things. And so in other words, if you see a huge sell-off in the stock market, that means that the yield is going to go down because investors are buying bonds as a flight to quality. They're scared something's going to happen. So if you see the stock market down, usually interest rates are going to follow that, mortgage interest rates, because investors are leaving stocks, they're going to buy bonds. Yeah. So basically, how can this help you? Well, let's say that you have a customer that is rate sensitive, and you see there's a huge sell-off in the market, and you quoted him here, and now you can get him over here at par. And this all can happen in a week. You don't know what's going to happen. Nobody knows. So tomorrow you could wake up. It's not likely, but there could be a 2 sigma move in the market, and you could have a par rate over here somewhere. So, or it could be the opposite. So the thing is that this right here represents the again the price of that rate. If you come down here, you start to look at it has a premium. When anything past 100 is called a premium. So 100.9, that's almost 100 basis points or 1% premium. That goes back to the customer as a lender credit. So on this $100,000 loan, they're getting $976 in credit towards their closing cost. Okay, so and it shows right here. It shows a negative.
So what you can do, if there's not a lot of concessions in the deal like that Miami deal you're working there, let's say you can't get a lot of concessions, and you want to, help them with the closing costs, you could just bring their rate up over here, and then pay, 1% towards their closing. So
and this is what you're talking about when you're saying when you told us lender credit, don't try to sell it, but if we need it, keep it in your back pocket. That's what you're talking about.
Well, yeah, this is called a lender credit, but the thing is that you could say that as far as using the word lender credit, I would say, look, we can help you with the closing costs. We have a credit that we can give you, but you don't want to just, kind of like when you're dealing with people, you're always playing chess. Okay, so you don't want to put all your cards on the table up front. You want to see, what the guy is going to, when you're talking to the customer. Why? I mean, because if you do that, if you always do that, then you could leave some money on the table. Okay, I mean, look at it like let's look at it like playing poker.
Yeah.
I mean, so really, because you're not going to come out there every time and say I'm going to give you a lender credit. You have to just look and see what's going on with the deal, and then see if that's necessary.
What's the downside to us? Say doing that on every deal.
Well, the downside is that we end up making less money.
The company makes less money
Yeah.
because okay,
Yeah.
I got you.
So, and the borrower is going to take a higher interest rate. So, but if it needs to get done, it's definitely not a problem to do it. If we need to do a lender credit, it's totally fine. It's not like it's going to affect us like we can't pay our bills. So it's not like that type of situation. It's just that you always don't want to come out there and just wear it on your sleeve. But it's if you again, I think Mark the other day, not you guys, Mark in Dallas, he had to compete against the builder, and he came in with a lower rate than the builder's lender and was able to give a bigger credit. And that's where you just pull that out and have that. So
is there kind of a break-even point for you guys where
no, this all this doesn't affect like me personally or our branch. Whether you give a credit or not, I meant like when we go to sell the loan is where it's going to affect us. Not like in our origination, our front end rebate. This won't affect us. Whether you quote this or this, it's not going to really affect us. I meant when we actually sell the loan. So so don't worry about that. So that we said you guys can offer it, and I don't want that to influence whether you're going to give a credit or not. I mean, if you need to do it to get the loan in, then do it.
Okay.
So now on the other side of that, if you're going to buy into the rate, you need to get management approval for that. You just can't go down here and start offering this stuff up here, okay? Because that you could get into a tricky situation.
higher price loans, right? Higher price loans?
Well, if it's a small loan amount, you definitely can't do it.
What's the max percentage for everything, cost-wise? What's the max?
The total front end is a 7.99%. You can't go over it.
Okay. So that's, because I was going to ask you that, like, how far do you go up? Where you stop? So it's about 7.9.
Well, we mean where do you go up?
Where do you stop as far as closing, like the costs?
The total front end fees?
Yeah.
Yeah, it can't exceed 7.99.
Okay.
But the thing is, yes, we can't be, if you need to get a deal in and you need to be somewhere over here, you definitely need to check with management before you do that. Because again, on a $60,000 loan, you can't even do that. So the loan's too small, and we're going to get into a high cost situation. So, all this is just translating over to just the different. This one's in percentages, that one's in dollars. And so that's all that is. The key thing to understand what influences an interest rate, obviously the timing of the market, the borrower's credit, and the loan amount. So Fernando, can you do a loan with a 720 with a 280 loan?
Yeah.
Do
USDA?
Yeah, do FHA. Do 270 loan amount, 720 credit.
Pricing's really good for FHA.
Yeah, do FHA.
Good credit.
Angelo, could you go, I mean, you're not gonna do it right now, but could you talk about when you actually, because I understand pricing it out to get like a quote to give to them and stuff, but what about actually like locking it in and stuff, or actually giving them the rate that they're supposed to get, or?
Well, that's going to be a whole separate training.
Okay.
Yeah, that's something that you're not gonna lock in the rate until you go to closing, basically.
Okay.
So that's another training that's going to be more in depth. And actually, Josh is probably going to be locking your first 10 loans with you,
Okay.
because you know you have to be very careful when you're locking an interest rate. You're basically reserving the bank's money for that loan, and if you don't deliver that loan, it's very bad.
Right.
So and actually, you can get cut off. If you end up locking a bunch of loans that you don't deliver, it's going to be too bad.
So these rates are kind of linked to 10 and 30-year bonds.
All the mortgage rates are.
That's right. So
Yeah.
so we can just assume that if the market's crashing, then everybody's going to be running to bonds, and bond prices will be going up,
Right.
and interest rates will be going down.
Correct.
Okay.
Correct. Yeah. Correct. That's right. So, here you can see this is an FHA loan. Now we've gone to a bigger loan amount. So look at this. We went from 100,000 all the way to 270. We went from a 640 credit. And what credit score is it? 720.
Put 740.
740. Okay. So what we see is that basically what's happened is we're at 3.5 par with Chase. And so we got about 50 basis points improvement from going to a bigger loan with a higher credit score. So this is telling you, hey, Chase is telling you, I'm going to buy that loan from you. And this is the coupon or the rate that I'm going to offer you with this pricing. And so, and you can see Wells, I think they're way up here, but they're too deep into the money. You're not going to be able to do that.
So you can get a huge credit, well, not huge, but I mean, pretty large credit if you just go up to
Yeah.
0.75.
Yeah, I mean here, yeah, I mean for instance, right here, if you do a 4% on this loan right here, 2 points times 270 is $5,400, and that'll cover their closing costs basically.
There's a column over to the right, shows you the dollar amount.
Yeah.
Wow, 54, 56.
Or 55.
Yeah.
So
Wow.
yeah, this is the credit they're getting towards their closing.
So that might be a good option for some people.
Oh, yeah.
Okay.
Yeah. Yeah, that's what I'm saying. It's such a powerful. This is why you have to understand with Supreme, you can never do this. Now with Supreme, you're always over here somewhere. So
Angelo, just as a question, so I have a deal, total closing costs are like $8,000, for example. They're getting 3% concessions on 230. So the difference in closing costs is about $1,100. I'm going to give them a credit, but the credit is larger than the amount that they need. They would get that cash back at closing.
well, there's earnest money.
Just earnest money?
Well, because that would be the differential, right? Probably.
No, let's say there's no earnest money.
Oh, there is no earnest money.
Well, no, just hypothetically. So let's say
They would have the seller reduce their concessions.
Really?
Yeah. They don't get cash back.
You know?
No.
What if the homeowner isn't staying in the home that long? What if they stay in there for 3 years? Wouldn't that really hurt wouldn't the bank really not to make too much money on that loan if they did a discount? If they bump the rate up and get them more money at closing costs. So say they did a rate at 4% here, and they gave $5,600 in closing costs, and the homeowner stays in the home for less than a year.
Mm-hmm.
But I don't think the bank would sell it under,
They sell it
they
already.
sell it probably at the same rate.
Well, no, I mean Bank of England is actually servicing our loans, but I'm trying to make sure I understand what your question is, though.
Well, I'm trying to think why would the bank give $5,600 in closing costs for a higher rate with the risk of somebody selling that home in a year and then not returning that interest to them?
Why would they?
Yeah.
Why would they do that? Because what happens is after the loans close, there's two different things that happen. there's the servicing of the loan, and there's actual the loan itself, right? So we're retaining the servicing of the loan, and then we're selling the actual mortgage, okay? And so that mortgage is getting sold to another investor. In this case, it's Chase. So, and Chase is the one that's buying the loan from BOE. And so Chase is telling them that basically the way it works is if you deliver this loan at this interest rate, then I'm going to pay you more yield. Okay, so obviously banks make more money on higher rates. So so they're going to give them, 2% over par by delivering this interest rate, and this one right here is going to be 2.89 over par because higher interest rate, to Chase, they're going to make more money off of it. Now, for us, for Bank of England, we can use that as a credit towards the customer's closing cost, and so we can make that extra money. Now, with the borrower, if they end up refinancing, usually within the first year, you're 100% correct. Or if they sell the house, and this is it's in your compensation agreement too. And I think we've talked about it, but I believe this is the first year or 6 months. If they refinance or get out of that loan, they come back and they take your commission. Yeah, because and then they're going to come back and take my money too. So
If they refinance what?
I think it's in the first 6 months or a year. I got to go back and check. It happened to me a couple times. It's happened to me.
So I think that'd be risky for them. So they would.
Oh yeah, they're going to come back for their money.
Okay.
And so, but I think it's a year.
Okay.
It's a year. It's only happened to me twice in my career. So no, actually it was a big loan. It was a $400,000 deal. So
And is that only when they are giving points back to the buyer, or is that also included when someone's paying for a much lower rate? That it seemed like it wouldn't work the other way around. If they're paying money to have a lower rate and they get out of that loan early, I don't think they come back to get your commission at that point. Really?
You're still getting paid your commission, yeah.
Okay.
Yeah. Because we're still, the way it works is, even if they're buying into the rate, everybody's still getting paid.
Yeah.
I'm getting paid, BOE's getting paid. So,
So say if someone pays, like in this situation, they pay $22.90 for a 3.25 rate, and they sell that home within a 12-month period. Let's say Chase wouldn't come back and take commission because they didn't lose any money because this person's actually paying for that rate.
no, they did because they still have to pay. They still have to pay my company, and they still have to pay BOE.
Okay, so they will come back.
Oh yeah.
So any loan within 12 months.
Yeah, they have to. They're going to come back and take your commission. They're going to take my money. They're going
So-
to.
So why wouldn't banks offer like a special 6-month refinance just to,
They don't want to do that.
oh, they don't want
Oh
to
no,
refinance?
that's bad. That's
Okay, so
bad.
them coming back for your commissions, actually, they're just trying to recoup some of that money that they're.
Yeah, because they lost all.
Gotcha.
They lost all of their premium
Gotcha.
when the person refis. So they don't want that to happen.
Right.
So they lose money because they want to collect that interest. And that's why they're trying to get the borrower to go up here because they want that interest. But normally most borrowers don't do that. They'll stay in the house on average for 3 to 5 years. But I mean everybody's different. Depends on the type of loan. Construction loans you're not going to do that. But
So if I was on the phone with someone and they told me they plan on making this a forever home, they're going to be in there in 30 years, maybe it might be worth it for them to pay a little bit more for a lower rate if they're staying there a long period of time.
Yeah. I mean, it could be. It could be, but I mean, you just got to look at it. I mean, basically what it is net benefit. So let's say that here, the price is 1 point, that's $2,700. So just do a 5-year amortization of the net benefit from 3 1/4 to 3.5. It's 1/4%. So 1/4% is $35 a month, approximately. So that's $360 a year. That's $1,900 that they're gonna save, but the points costing $2,700. So there's no benefit in that many years. So you have to look at it and see, because this fools a lot of people. That don't know about finance. There's no difference here. So, and then the other thing is that really, if you really want to get someone a good deal, you probably put them on the arm. Most smart people don't even do a fixed rate.
Right.
So every loan I've had, I've always had an arm.
Well, especially if you know you're only gonna keep the house for like 5 years or something, you just get maybe even interest-only payments or something.
I always did interest only or
Yeah.
arm. I never would do a fixed rate, because you can get, the arms are right now, you can get them for 2.25, 2.3.
And they've been going down. They're consistently low.
Yeah, and you can get them, locked for, usually 5 years or 7 years, but most of your customers aren't gonna even,
Right.
you're rarely gonna talk to those type of people, so.
Right.
You will sometimes, if they ask about it, yeah, we offer them. So, and FHA has arms too.
Mhm.
So, and I'm not saying that our people aren't smart, I'm just saying that that's not the way they think. They don't want to even worry about, they don't even want to think about all that stuff. About their payment recasting and all that. So they don't, so it's best just to stay with this for now. I don't want to overwhelm you guys. And, pretty much 99% of what you're going to be doing is fixed rates, unless, because you're a realtor, you might have a buddy that wants to do a big loan, a jumbo or arm. Yeah, we got them. And so, and we can go over all those. But basically, that's how it works when you're pricing loans. And so I don't look at this all the time. I kind of know what's going on in the market. I can just tell, I'll tell someone the rates are 3.5. And just go with that for a few days. Unless I see a huge swing, then I'll tell them, it's different. And so I don't need. It's good to have. That's why I sent out that market update every day. You should definitely. He's doing a presentation next week on that, because there's a bunch of stuff in there on graphs and things you can send to the borrower in addition to the biweekly plan that MBS Highway has, that are really, really effective tools on helping to sell your loan. I met Barry when we were up he's at the Mortgage Mastermind, that's his company. And, they have some really cool stuff in there that you can use to help to sell pitch your loan to the borrowers. And so, like different graphs and charts, and, one of them was like, okay, depreciation rate it was an area in Austin. It was Kyle was appreciating like at 5% annually. Okay, and Barry was talking about the guy didn't want to up the bid on the offer by $4,000 and was getting ready to walk away. And Barry sat him down and said, "Look at this for a second. This chart. In the last 5 years, Kyle's appreciated by 5% annually. So we just say that. Let's just be conservative and say that Kyle appreciates by, let's just say 2% annually for the next 5 years. Okay." And you show them the value of the home today versus the 5 years out, and the house went from like 280 to like 340. So he says you're going to give up 60 grand for just an extra $4,000 in the offer. And he showed this to him in a graph. It's a no-brainer. That's a great investment. And so that's and that's how you want to be able to sell that to somebody. Like your deal, like you had in Miami. Maybe they needed to up the offer. Maybe you said Miami's going gangbusters. Maybe the value would have went up. I bought my house 5 years ago for $220. It's worth $280 right now. I didn't have to do anything to make that $60,000. So
how long ago? 5 years?
Yeah. So
yeah, we bought for $220. We sold for $335. We got 2 cash offers at $335, one at $338, and nothing below. It was all.
Sometimes that happens. Sometimes it happens the other way. Generally, real estate does appreciate generally. Not at staggering rates, but that's a good pitch to use. And he's going to do a presentation on that next week. But anyway, that's how it works when you're pricing loans. And you don't need to get into all this. Who's buying the loan, all that. That's not. Don't even get into that with the borrower, because they're going to see on their servicing statement is Bank of England. So do not get into any of this. And one thing, when you're talking to your customer, man, keep it very simple. I would not go into all this stuff with them. You start talking about, I'm gonna, give you a 2-point lender credit and it's a 30-day lock. Most of your customers, they just want to know really what their payment is and what's their cash to close. If you get too much beyond that with them, you're gonna lose them. I mean, just not lose them as a customer, but they're not going to be able to probably stay with you on the call, as far as understanding what you're telling them. I mean, and you have to understand, who you're dealing with is a millennial first-time buyer. Now, not everybody's like that, and if you feel like you can talk to somebody about it, I think it's good that you have the knowledge and you can explain it to people how it works, so that way they need to perceive you as the expert, and that you know what you're talking about. And so does anyone have any questions about it, or is it pretty simple, or does it make? I mean, now that you saw it again from 2 weeks ago, Mark.
Yeah, I think it's sticking this time.
Okay.
A little more.
Yeah, you need to see it many times, and then that way you can get more comfortable with it. So, what about you, Mark?
I don't totally understand everything, but
That's
a
okay.
little bit.
Okay. That's good. That's a good thing, though. You gotta. So, I mean, basically, just to kind of look at it right here. I mean, these are the interest rates, and you'll see all this as you get closer and you get more into it. And again, this is the locks have a expiration date. They actually have a they're time sensitive, and this is the corresponding premium or cost for that rate to deliver. And so, we're going to keep bringing it up over and over and over again. But this is right now just to introduce you to it. We're going to do another one next week when Flavio starts, and so I'll just keep doing it over and over. And then we'll do another one on locking rates too. But again, you're not going to be locking your own rates on your own for probably not until the end of the summer.
Okay, and so what I would want to know is, since the rates are always changing and you're kind of quoting them like on a credit or something, kind of, let's say you're hoping that they're going to get a credit, right, at closing, and you lock it later. I mean, how is that affected if they don't get the same credit as before?
Well, okay, well that's all in how you explain it to the borrower. I mean, so basically, when you're talking about interest rates to a borrower and pricing, you have to let them know this deal is effective today. Okay, we don't have any control in interest rates. Okay, you're dealing with a ever-changing, fast-moving market, and it's not me. I'm not making this. This is not me making. I'm telling you what it is. And so, if you want to lock your loan in, then we have to get you under contract and get all your stuff in. That way we can secure that rate. So, if you explain it to people and they understand that, look, if it took you 2 extra weeks to get all your documents in, and now the rates have gone up by 50 basis points, that's your fault. I told you I need these documents right here, and it took you too long to get them.
Yeah.
I couldn't lock your rate. Okay. So, so in other words, what could happen is, let's say that in that case that you quote somebody right here with a 1.4 lender credit, and now all of a sudden the market moves against you, and you're at 4% for that same credit. That happens all the time.
Okay. So we don't, let's say we're relying on a credit there. I mean, that's not really going to affect us. We can make it happen down the line.
You'll still be able to offer the credit, but the rate could go up or down.
Okay.
But you have to explain to the borrower that you're not in the business to guarantee. You cannot guarantee an interest rate.
Yeah.
Unless the loan is ready to go into contract right now, it's a full file, and then you can lock that in.
Okay.
And we have a solid loan. It's getting ready to close, and so you can't lock something in that is still questionable of the value of the property. We don't even have a conditional approval from the underwriter. You can't lock that loan in. So you have to explain it to the borrower that this is the rate where we're at right now, 3.5. So for FHA, that's probably what you guys need to be quoting right now for this type of loan, 640 and up, higher loan amounts. And so And for smaller loans like 600, 620, 4%, 3.99. 3.99 sounds better. So, and that's what it was. But that's not their locked-in rate. Okay, and they really need to understand that you cannot lock in the interest rate until we actually get the commitment from the underwriter, and then the appraisal is approved. So yeah, I mean that can happen. And you just need to do your, make sure that you're explaining that to the bar, because you're right. They can go back and say, well, David lied to me. He said I was getting 3.75. He's a liar. You don't think you can say that?
Oh yeah, I know they would.
Yeah. So you need to explain to the borrower how that works. I mean, it happens in many different businesses. I mean, I think you said you work construction, like lumber and concrete, all that stuff changes all the time, right? And now normally they can get a lock-in from either the lumber yard or whoever they're working with, and they'll say on the bid, good for 5 days, good for 2 weeks, good for 3 weeks, whatever, and that's it, because those prices change all the time, right? So, and I always use that analogy. I mean, look at your gas. Are you going to yell at the guy working over there and behind the glass because the gas went up? So,
How big?
yeah, no, I always use that when I talk to people, because that change. Go look over there; it changes every day.
Yeah,
So, I mean, it's not him,
it's like saying,
He gets a call or an email,
yeah,
and his boss tells him to go change it
yeah.
because the price of crude changed, so I gotta go move it. So, believe me, he has no idea what to put.
Yeah.
So,
No, that's a good analogy that you use, because
Very good.
you never know. You got to do it today.
yeah, I mean that's where we're at.
Today, yeah.
Now, if you have a lot of money, you can go and buy a 1-year futures contract and take delivery of 40,000 barrels of oil,
Yeah.
and then or gas, and then store that somewhere for.
So primarily though, if you give them that rate that day, they're going to have no full control over getting that rate. It's dependent on the underwriter getting back. So really, when we're giving that, there is some, they can't say, okay, I'm ready to do it today. Let's lock it down, whatever. We have to wait for the underwriter.
What are we locking down though?
Oh, right. I mean, well, the rate, to lock
Well,
the rate.
you have no property, and we don't know what the property is going to pass inspection or appraisal. We don't know if the borrower is going to be employed when we're underwrite the loan. I mean, I've seen it doesn't happen that often, but sometimes the borrower will lose their job. There's a lot of risk, and I'm not saying that you're not gonna have locks that bust. It just doesn't look. It does. If you have too many of them, they're gonna cut you off from locking rates. Is what's gonna happen. Normally, if you have five locks that bust, you're probably gonna get cut off from locking rates. So
5 locks that bust was
you didn't deliver the loan.
You locked it in, something happened.
Yeah, you didn't deliver the loan. So
So
that's
you really want to be sure when you lock it
Yeah.
that it's going through.
Yeah.
Gotcha.
Yeah, they're going to be looking for that loan. So, and it's not. I understand you're trying to appease the customer, but until we make sure that we have a deal, we can't lock that rate.
Gotcha.
And when I mean a deal, I mean we have the appraisal in and we have a conditional approval. So, because it's just you're putting yourself in harm's way to lock something that really had no business being locked. Just because you get someone pre-approval, I'm gonna lock you in. No.
So it's really important to make that disclosure when they're giving them this on Optimum Blue that this is a
Like
snapshot of
when
today.
you do your pre-approval letter, I mean it already has, or it should have
It
a
does.
disclaimer in there. This is the interest rate today,
Right.
It's
and
not guaranteed to lock.
yeah,
Yep, exactly.
it should be on there.
It is.
Okay. So, I mean, this is not something this is not a bait and switch, it's just how it works in our business. And so, it's not something that's static. And it's way beyond our control, way, way beyond us. So, anyway, Josh, I know you wanted to add something on disclosures real quick, so I'm done with this. If you want to go ahead and add your piece.
Yeah,
You want to do it over here?
yeah. I was actually gonna have Angelina.
Oh, okay.
Do it, but
Okay. You go get
I
it.
didn't have any Compass installed over here. It was something with the 4506D.
We went over transfer taxes and we went a little bit deeper into how to price loans. Some of the people are requesting if you can teach them how to lock loans, maybe when we get some to lock. I told them they probably won't be locking their first 10 loans. I mean, unless whatever you want to do on that. But in the beginning, probably need to be with them to lock them.
Yeah, and in some cases, with rates this good, I mean, we might do, just lock them up front, do a 45-day lock. A 45-16.
Oh, yeah.
Do you want to explain that to some of these guys?
Can we put Encompass up here, or? No, that's fine. Huh? No?
Right, then, but that's a second.
Oh, no, it's fine, don't worry about it. Oh, it's not on there.
I can now. Here it goes up now.
Well, I was just gonna, okay.
You good?
Okay, I sent out an email earlier today about the 4506T, not populating into the loan disclosures when you guys are sending out docs. We've noticed it on a couple of loans so far. So what has to happen is, when you're completing the loan data into Encompass, you actually need to go to the screen under forms, and I sent you little snapshots of it. Request for return of tax transcript, and then click on the TSL services. In the drop down, you'll select borrower. If it's co-borrower or both, and I think there's another option too, and then you'll select copy from borrower, and then save that information. So when you do send out your initial disclosure package, the information populates onto the 4506T form. So when the borrower e-signs it or ink signs the paperwork, it'll come in properly so we can order the tax transcripts. Since they already take anywhere from about 2 to, I would say, sometimes 5-7 days, business days, depending on how the IRS is working. You want to make sure that that's done correctly, because the 2 loans that we have it in on, I had to send one to the borrower, Saeed sent one to the borrower to go get it completed correctly, and then you have to wait for them to send it back, which could cause a delay in your closing, is where we see a lot with the tax transcripts. So it's just a heads up when before you send out disclosures to properly populate that information. Is that Encompass?
I think so. Bam.
Oh, okay, good.
Who's the man?
Okay, so Mark, can you navigate through there and then go under forms to scroll down to request, or it's under R, right here, request for tax transcript of tax. Okay, so you'll come here, and you see this one here. It's not going to pop. It's going to send the form out blank to the borrower, and we won't be able to use it when it comes back. So what needs to happen is he selected the default TQL, which is right, and then he needs to click copy. He needs to open this one, the drop down. Is this just 2 people? So we need both. I presume they file jointly.
Pick both, is what you said. Borrower, co-borrower, or both. In the drop-down menu, you can pick
Right.
borrower, co-borrower, or both.
Was it 4506T?
Yeah. Oh, you weren't here. So we saw on the 2 loans that have come in that they've come in blank, so we can't even order the 4506T. I'm waiting on mine to be returned from the borrower, and so is Saeed, which will cause a delay. In closing if you don't get it done right.
What are you
Are
doing?
you talking about mine?
No, I haven't. I'm pretty sure.
No, now with yours.
I'm pretty sure.
Well,
I don't
yeah,
know
it's
how
gonna
yours
happen
is.
on yours too.
If you didn't do this, then yeah, it'll happen on yours.
I want to go to one with 2 borrowers on it. That was, I don't even know if that was it. Hold on, give me just a second.
That one had 2.
They had 2 borrowers. See that top bar right there? If you see 2 names up here, you have 2 borrowers.
Jacob and Rebecca.
Right there?
Yeah.
That's
So you have 2 there.
one application.
But you want to make sure that, in that case, when you select both, that they file their tax returns together. If they file separately, then you wouldn't select that. So you have to look at the tax returns. So let's presume they file jointly. Okay, you already have the default TQL rules checked.
Zoom in a little bit.
And then copy from borrower summary. Okay, now scroll down. Eventually, the LOs will be responsible for ordering tax transcripts after the transition period. So this is very important that you do pay attention to this because you are going to be doing this. See how this information populates? Box A, return for transcript. C, record of accounts. And then 8 is the form W-2 1099. Scroll down. And then you want to make sure we're adding in 2012 here because not everyone's filed 2015 yet because it's not required. So manually type in 12/31/2012. This all needs to be done before you send disclosures. Right, if
4
you-
years.
Oh, 4 years?
Yeah, because 15's not, may not be
2012.
available. And in case you're doing MCC.
Right. We do need, for MCC, you're required to have 3 years of tax transcripts. So that's also why we're doing this too. Now keep in mind, if you have a borrower that ink signs their forms or comes into the office or live signature, there's a box. Can you click on print but preview the document? So you'll save this after you're done doing this. And then you can go ahead and do preview here.
Which one you want? This one?
Yeah, that's fine. Okay, so a borrower that ink signs in person, mails and docs, whatever, scroll down, they have to manually put in an ink X in this box, not a check mark. The IRS will return it. It has to be manually done in ink. The date here cannot be typed in if they're ink signing. It has to be manually handwritten. When they e-sign, it'll be e-signed here, e-signed with the date, and then that box will have a little blue X in it. Scroll up. Now this is, here they file jointly, we're assuming. Do you want me to go over their address information because that's later when they start ordering transcripts?
We can do a separate
Okay.
training on that. I think that's gonna blow my mind a little bit.
Okay, so you would just,
This is not every one. We need this.
Mine's already fun.
yeah, before you send out disclosures, yeah, you need to do this.
Don't get discouraged.
On the,
It just takes 2 seconds. It's not.
No,
the
it's-
appraisal,
Uh,
I know this is going to something else, but I know you're talking about the ink signing and everything. On the appraisal, is there any way for them to do it any other way? other
no, what
than
happened
them
was,
signing it?
right, yesterday we tried to order one, the appraisal payment form was left blank, so I typed it in. We sent it to accounting said no, it has to be handwritten in the amount. That's why I'm saying you guys have to choose your vendor up front, check the amount on the charts I sent you, tell the borrower, hey, write in $495, $550, $520, whatever it is. They have to manually put that in themselves.
There's no other way.
For now until after May.
What I would do is take the appraisal payment form and just write it for them and send it to them and say, can you finish signing this and fill it in?
Complete it. Yeah, that's an option too. That's probably
Yeah,
better.
don't say, hey, go look at the sheet and go fill it in, that's retarded. They're not gonna do that.
No, not them to do it. I'm saying the LO.
Yeah.
The
so
LO would
you're
do
gonna just write it in for them and send it to them. Now, there is another way. There's always another way. It's just gonna take time for them to change the way that they operate. It's probably gonna be May or June before.
Yeah, it'll be
before they
smoother
change that
after.
system.
Okay.
Yeah, it'll be like
Because
before.
this lady, she don't have no printer or scanner, she gotta wait, so.
Well, that's why I say I sent you the pricing ahead of time, like Josh said. That's a good idea because the form is blank when you're sending it to them. So just fill in the price right there for them.
Yeah.
Choose your vendor up front. That way we're not waiting because right now we have 2 files that we can't. We ordered appraisals on, but they can't process payment.
Wow.
So if that gets caught in the loop with like 60 loans and cars get declined and things like that, we'll have to take that cost. That's why we want to make sure we're getting it done right up front.
This is temporary.
Okay.
Yeah.
It's not a permanent thing. It's how they've been doing it, and it's not the most efficient way. But,
No.
anyway, can you go back to the 4506D
Is that
inside Encompass real quick?
Is that still part of the disclosures?
Yeah.
Yeah.
The 4506D is, but you have to manually go in to the file and populate the information.
It's not gonna auto-populate like it did before.
Right.
At least at the present time.
Is it e-signed or a wet doc?
It's e-sign. Now, if it's not filled in when you send out with your e-signature packet, meaning that it doesn't have the borrower's information inside of it because you didn't populate it, then you'll have to do one probably manually.
Are there still wet docs? Like,
Only the borrower's authorization.
And the 3555. No wet doc 1003.
3555 would just be for USD authority.
Right.
Right. They can, the problem with this is, once it's already come to processing, we have to send out a new one to the borrower. Either we can electronically send it or we can send it manually by email. We can't type into the form because CoreLogic is a little bit different than any other vendor we used, and they said that they were getting returned. I had a call today with corporate.
Hop back in. Don't save the changes.
Does anyone want to practice it on a file? I think that Mark already did one. Maybe it's another person just try it.
Who's
to get
gonna be
comfortable.
close to sending out docs? You. Go on, Fernando. Get in there.
Come on, Andrew.
Let's see what you made of.
Here we go.
Fail.
You read it, son.
Yeah.
The easiest way I like to do it is show on alpha and show all. Because that'll put everything.
What is it called? So what is an R? It starts with an R.
Come on, Team 8, you guys gotta help him. Who was
Andrew
taking
should know
notes?
it.
Starts with an R, I know that.
Starts with an R. Go down. Request. There you go. Somewhere there. Yeah. Well, hold on. Scroll down. I just want to make sure because if you look, this is going to be filled in by default. The 3 check boxes you need and 3 of the years. So you just have to fill in that 4th year and then populate the information.
Do we have to change anything if they don't work? If I
If
If
remember,
they file the tax return,
If they don't file,
it's going to be rare that if they don't, they still need to sign 4506T. Yes.
click
do
box
we
number
have to change
7.
anything?
Yeah, click box number 7, verification of non-filing. Some
Yeah.
underwriters like to see that.
That's
The
good
receipt
question.
of non-filing.
Is that just for current year or is that
That's for all 4 years.
You're ordering
Whatever
for
years
all
you
these
put.
years.
if you never filed? Okay.
Yeah, by putting those years there, that's the years that we have authorization to verify.
Okay.
We can go to the IRS and pull your W-2s, your 1099s, your tax returns based on what's on this form, and confirm that the documentation that you're providing us is the documentation they have on file.
So we have the tax returns, contract box 7. I got the 4 years in.
Well, hold on a second. Go back to the top. How many people are on this loan? Let's just assume they file jointly.
So borrower,
Well, let's assume they file.
Come on, Fernando.
Come on, William.
borrower.
Come latte.
Both.
Come on, come latte.
Okay.
I didn't see the vote.
Ah.
You have your check mark there. Now let's go into our next step.
We really had to type in their name.
Man.
Oh, go up
That's
right
what
there.
happens when you don't take notes.
I went to the restroom. Give me a break.
No, you scroll all the way down.
Bada boom.
All the way down. Okay, see that the phone number popped up too because prior the phone number wasn't listed. So you want to make sure you're selecting that.
And there's going to be a separate training on actually looking at tax returns and filling in because a borrower could have a different address on a tax return and lead you to having to enter that right there in that box. I would assume, right?
What if they moved 4 times in the last 4 years? Just hypothetically. So box 4, there's only room for 1 previous address.
It's the one that's filed on their last tax return, their most
Which is the
recent
most
tax
recent
return.
Their most recent,
On the tax return.
yeah, and in some cases, as a previous, you'd want to indicate the one from like 2014 on the tax return.
And then you
Doesn't
just,
really matter where they could even use a different address on the tax return that they've never, maybe it's mom and dad's house and they've been everywhere else and they just use that for their tax filing.
right, and that'll be a separate training. Make sure that if you're putting somebody lives rent-free with family in the present address, if it populates here, you'll want to take that out because it's going to reject your transcripts. So you'll just save it and then you can send out your disclosures. Anyone else want to try it?
Don't say this.
All right.
I think everybody should, because you get comfortable with it.
live.
Look at that, he was showing you, look, I see there's two borrowers here. He's showing you his work.
It's a long division.
Saw that mouse loop.
You can sense the attitude,
He pretends he reads it all.
the confidence. Very good.
Still checking his work.
Let's say that they're on Social Security, they don't file tax returns. What do you want to put up?
Oh, let's see. I want to go here at 7. I'm gonna click that. I'm done.
Oh,
Good.
John's master.
That's it.
Wow, that was easy. I love it.
David, you ready?
Yeah.
Boom.
Let's put it.
Oh, let me get out.
Let me close my eyes.
Let's go in a different file besides Miller, so you guys can't remember exactly where you're going.
Film's still rolling.
It's still a curveball.
All right, Jimmy Slade, Jimmy Ray. All right, here we go. We're on the forms. We're requesting. Now look at Jimmy Ray. This one guy.
Nice.
Borrower. I'm gonna go ahead and copy. Make sure all that's filled out. Jimmy Ray. All right, that's good. We're gonna do a return.
Why didn't that come pre-populated?
Huh.
And the
It
check
didn't
mark,
because here.
You didn't have that box checked?
Go, he has to select default to TQL.
Default. I knew that. I was gonna do that. Maybe.
Go back down, let's see.
After you went checking each one?
I didn't want to tell him until after he was done.
Oh.
That's why, but it's okay.
I like doing the hard way, you know? Well, and then the phone number,
Populates when you click borrower summary.
boom, everything's good.
Nice.
And if we're using MCC on a loan, how many years tax transcripts do we need?
We're gonna need 3.
So you
You do 12 no matter what because you want that authorization for the 4th.
Not everyone's filed 15.
Okay, gotcha.
Not
So
until
that's what we're doing.
April.
Not till April, right? Yeah.
April what?
Even then, if they file an extension,
Yeah.
you're not obligated to provide a return.
I need a file extension.
Gotcha. So if they didn't have 15, they'd have to go 14, 13, 12 for the 3.
That's if you're using MCC.
MCC.
What you're doing is
Gotcha.
you're giving your processor the ability to basically, you give them a maximum so you make a decision on whether or not they need to float down to
Yeah.
2 years or 3
Gotcha.
years. You give them the option,
Gotcha.
right? If you limit them, then they go, I gotta go get another form signed, and why not just add an extra year, toss it out
Get it
there,
in one.
right? It makes it easier, and most people don't, usually have any question, anything, especially when this comes in a packet of like 40 pages.
I've always wondered, we look at last 2 years, right? So we, right now we're looking 2015, 2014 tax returns W-2s. Why do we always need the previous year, 3 years for tax transcripts?
Why do we need it?
Yeah. Why is it required 3 years when most of everything is just the last 2 years? Why is it 3 years for tax
You
transcripts?
don't need that third year, you just need 2.
MCC.
You just need 2, but if you're using MCC, you're gonna need that 3rd year, or let's say your processor sees that the person who just filed the tax return for 2015 today. Well, it's gonna take about 2 months for that return to get processed by the IRS. So if your processor takes that 2015 return, sends it into underwriting with your loan, now that loan's closing will be delayed for 2 months. But if you have a good processor and they see you have a 2015 return that was filed today, they'll junk it, okay? To take it out if you don't need it. Why am I going to use it? And just use the 13 or 14 returns and those 2 years transcripts. Because when you have a newly filed return, you have to wait for that return to be processed by the IRS in order for underwriting to accept it. So if there's a borrower that's filing a return, just keep in mind if it's something that they're like self-employed, it's going to take like 6 to 8 weeks for that return to get processed if they're doing it now around this time of the year. And the underwriter is going to want to see that it's been processed by the IRS. They can verify that return. So they're not just going to take a return that you provide and say accept it for what it is. They're going to want to see that the IRS has a record of it and then the numbers IRS has are identical to what's on that return that you provided. So it just gives you the flexibility, but you only need 2.
No, that makes sense. Yeah, that's the flexibility thing is why then. I get
Yeah.
it. Yeah.
That's the only reason.
Okay.
The current year is because whether they file the return or not, and that other year is for the MCC. All right, that's it, right? Do you want anyone else to do anything?
Does anyone else want to try it?
No? Okay. All right. We can shut off the recording. That's it for the evening. Thank you, guys.